Hi, my name is Nicole. I was recently hired as a consultant with Kroenke Company, who has asked me to figure out what their corporate cost of capital is. Their preferred capital structure is 40% debt, 10% preferred, and 30% common equity. The after-tax cost of debt for the company is 6%. The cost of preferred is 7.5%. And the cost of retained earnings is 13.25%. With this information, I'm going to be able to calculate the corporate cost of capital for the firm, both manually and using Excel. In order to solve for the corporate cost of capital for this company, I can use the formula which states that the corporate cost of capital is equal to the weight of debt multiplied by the rate of debt, which is the cost of debt, and then multiply that by 1 minus the tax rate. This would give us the after-tax cost of debt. Then we add that to the weight of the preferred stock in the capital structure, multiplied by the rate, or the cost of it, and then add again the weight of the common equity times the rate, or the cost of the common equity. In this example, we know that the company's target capital structure lays out the weights of each type of capital. So we know that debt is at 40% of the capital structure. The preferred equity is at 10%, and the common equity is at 50%. The costs of each of these is 6% cost for debt, 7.5% for the preferred, and the cost of retained earnings on the common is 13.25%. Now I can enter all of these figures in the formula. So I see that the corporate cost of capital is equal to the weight of debt of 40%, multiplied by the rate, or the cost of debt, which is 6%, plus the weight of the preferred, which is 10%, multiplied by its rate of 7.5%, and add in again the weight of the common is 50%, multiplied by its rate of 13.25%. Once I do those calculations, I find that the corporate cost of capital is 9.78% for this company. You'll notice that when I was putting in the cost of the debt, I didn't multiply it by 1 minus the tax rate. This is because the information that I was provided with gave me the after-tax cost of debt of 6%. When I am given the after-tax cost of debt, there's no need to multiply by 1 minus the tax rate because the tax rate has already been taken into account. I'll now solve this problem using Excel. Now to solve the corporate cost of capital using Excel, I'm first going to enter all of the information that I know into Excel. I know that we're working with debt, preferred equity, and common equity. And I also have the weights of each of these. The weight of debt in the structure was 40%, which I'm going to express as a decimal. The weight of the preferred was 10%, and the weight of the common was 50%. I also have the costs of each source of capital. The after-tax cost of debt is 6%, again expressed as a decimal. The cost of the preferred is 7.5%, and the cost of the common is 13.25%. When I use the formula where I did the weight of debt multiplied by the rate plus the weight of the preferred multiplied by its rate, and so on. What I was essentially doing was a sum product of these. So when I'm going in Excel, instead of writing in each separate cell and multiplying it and adding them as necessary, what I can do is use the sum product function. And what that does is it allows me to select two arrays that will be multiplied with each other and then added. So I can take all of the weights as the array 1 and then use all of the costs as the second array. And again, I get the same answer of 9.78%. To prove that this is the same as just adding and multiplying, I can do it that way as well. So I would take the weight of the debt multiplied by its cost plus the weight of the preferred multiplied by its cost plus the weight of the common multiplied by its cost, and I get the exact same answer. The only difference is that the sum product method is much quicker. It's important to note that we can only do this when I'm given the after-tax cost of debt. Otherwise, I would have to account for the cost of debt by multiplying the rate of debt by 1 minus the tax rate. So when using the sum product, it's important to make sure that whatever is in the array is the true cost that you're using and that you don't have to adjust it.